Boom, welcome back. This is StockBroc. Today I am doing a deep dive into a small cap gem, opportunity, or value trap. Which one do you think it is? The stock that I'm talking about is HNST, Honest. The Honest company sells diapers, wipes, personal care, wellness products, clean lifestyle, natural product niche. Fiscal 2024 revenue hit $378 million, up nearly 10% from the prior year, with a return to profitability. Net income of $6.5 million and improved margins to nearly 39%. The company recently reported Q2 2025 revenue of $97 million, a 13% year-over-year increase, and continued margin expansion. That's something you definitely want to see, especially for a small cap company like Honest. So, doing good so far. According to StockAnalysis.com, and a consensus of 5 reputable analysts, Honest currently has a buy rating. The 12-month consensus price target is $6.75, representing a 76% upside from the current price of around $3.80 to $3.96. JP Morgan and other sell-side shops highlight Honest margin expansion and niche growth, especially with the new clean conscious diaper rollout. Just a recent product that Honest came out with, and they also have the flushable wipes that recently came out as well. Market cap is $427 million with a PE ratio of nearly 63x, which is pretty high, and a forward PE of 51x. Well above the personal care industry averages, signaling a premium for growth and brand value. So basically what that means is this company is trading pretty rich in valuation. The high PE is due to Honest's fast switch to profitability after prior losses. If the company achieves analyst projections, continued double-digit revenue growth, and margins hold near 39%, the forward PE will compress, making the current price more attractive. So got to kind of stick around or pay the premium valuation for a company that just returned to profitability. The valuation relies on Honest sustaining sales momentum and controlling costs. Any slip could result in a sharp multiple contraction. And as you can see on their earnings call, they did cut costs by about $5 million in SG&A, I believe, and that was pretty good to see. Revenue about the same level, which wasn't super exciting, but the margin expansion and the profitability, return to profitability, is great for the company and the stock. Some of the strengths: strong brand recognition, fast-growing segments, diapers, clean beauty, margin momentum, no dividend obligations, freeing capital for growth and investing in the business. Recent earnings call suggests management is executing on distribution expansion and product innovation, supported by a solid leadership team. Analysts see room for Honest to capture further market share if it continues outpacing traditional consumer growth rates. Volatility: 52-week range is wide, $3.32 on the low side, high of about $9. Beta is very high at 2.34, which makes this stock a high beta stock, which means massive swings are the norm for this stock, sort of like crypto. Some of the risk: the volatility, the high beta, valuation risk with a high PE of over 60. A miss on future earnings could spark a sharp sell-off by investors. Forward valuations depend on Honest killing it quarter after quarter. Competition: major CPG firms like P&G, Procter & Gamble, Kimberly-Clark are ramping up natural product offerings, squeezing margin potential. And those bigger companies have a lot more to invest in their products to make it better. So it makes it hard for the smaller companies. But sometimes the smaller companies capture new ideas or steal ideas from the bigger companies and capitalize. Profitability: while Honest is finally profitable, net margins remain razor thin, and cost shocks like raw materials or supply chain issues could reverse progress. And that was mentioned in the 10Q. something that you should be doing if you want to research a company like Honest to kind of see some of the risk and the management comments about the company and about the future for the company. And another last red flag risk is execution. The turnaround is recent. There's limited margin for error. So returning to profitability is a big thing for a company like Honest, and they need to stay on track. Any movements off the track could bring the stock down. But this is why it is a high beta stock. It's a little more risky. You want to manage your risk and have a plan for if you want to join a company and invest in a company like Honest. That dilution in shares was a little concerning as well. Another risk red flag. They seem to dilute, raising capital for the company to basically invest in the business. It looks like I haven't done too much research on this company. Some of the price targets, analyst consensus, $6.75. That is a 75% upside. Weighted average of 5 major analysts, 4 PE implied 2025, $5.90 to $7.20. So that's a upside of about 49% to 82%. Bear case, low price target of $2.50 and $3.30. That's a negative downside of 17% and 36% if there's any missed growth or margin contraction. Bottom line, Honest is a high risk, high reward, small cap play. And with the rate cuts coming soon, a company like Honest could benefit with higher rate or more rate cuts. But the concern is we may have rates higher for longer and could hurt companies like Honest as quarters go on and on. We have those higher interest costs and borrowing. At least Honest does not have too much debt, which is good, but just something that could hurt the business if they want to invest more. But basically, it's a high risk, high reward play, credible upside if growth and margin trends hold. But premium valuation, industry risk could trigger sharp reversals. This stock suits aggressive growth investors willing to stomach volatility and demands tight risk management and ongoing due diligence. Doing your homework, staying on track. Are you betting on Honest to stay honest with its numbers? Hit the comments, hit the like. Thanks for watching. This is StockBroc. Peace out.